Welcome to Finance in Focus, where today we are diving deep into the crazy world of market psychology. Ever wonder why the stock market acts like a roller coaster? It's all about what's happening inside our heads. To explain, let's meet our cast. First, me, your friendly neighborhood financial analyst. I like data, charts, and calm, rational decisions. Then we have excited investor. He is the guy who just heard a hot tip and is ready to bet his life savings on it. He sounds a bit like this: to the moon. I'm gonna be rich. This stock can't possibly go down. And finally, our dear stress bear. He's constantly worried, checking his portfolio every 5 seconds, and lives in a state of perpetual panic. He's probably muttering something like, "Oh no, it dropped 0.1%. We are all doomed. Sell everything. The sky is falling." These two forces, greed and fear, are constantly battling for control of the market and your money. My job is to help you ignore them and focus on what really matters. Let's start with greed, the force that fuels our friend, the excited investor. Greed is that little voice that whispers, "What if this is the next big thing? You could make a fortune overnight." It's driven by hype, FOMO, the fear of missing out. Imagine a new tech company, Quantum Leap Gadgets, suddenly gets a ton of media attention. The excited investor is all over it. Dude, have you seen the news? Quantum Leap is going to change the world. Their new toaster can also predict the weather. I'm putting all my money in. It's at $100 a share, but it's going to 1,000, easy. This is pure hype. He hasn't looked at their financial statements, their debt, their management team, or even if their toaster actually works. He's just chasing the rocket ship, blinded by the potential for quick, massive gains. The problem with this is that hype creates bubbles. Prices get inflated way beyond their actual value, and when the bubble pops, and it always does, it's a long way down. Now, let's talk about the other side of the coin. Fear, perfectly embodied by our stressed bear. Fear is the polar opposite of greed, but just as dangerous. It's the feeling that takes over when the market starts to dip. Our bear is probably panicking right now. It's down 2%. I told you this was a bad idea. We are heading for a crash. The entire global economy is collapsing. I have to sell everything before I lose it all. He sees every red candle on the chart as a sign of the apocalypse. When everyone starts panic selling like our stressed bear, they drive prices down even further, often selling good, solid companies at a massive loss. This is what we call a market correction or, in extreme cases, a crash. The irony is that these moments of peak fear are often the best times to buy, but our bear is too busy liquidating his assets to even consider it. He sells low, and when the market eventually recovers, he'll probably buy back in high, once he feels safe again. A perfect recipe for losing money. So we have the excited investor buying high, driven by hype, and the stressed bear selling low, driven by fear. See the problem? They're both making emotional decisions, not logical ones. So what's the solution? Well, that's where I, the financial analyst, come in. My approach is, well, a little more boring, but a lot more effective. When I hear about Quantum Leap Gadgets, I don't immediately jump on the bandwagon. Instead, I pull up their financial reports. I look at their revenue, their profit margins, their debt-to-equity ratio. I research their competitors. Is their weather predicting toaster really a game changer, or just a gimmick? My mantra is simple. Okay, the hype is interesting. But what do the numbers say? Let's analyze the fundamentals. What is the intrinsic value of this company, separate from the market noise? I look for strong, stable companies with a proven track record and a clear path to future growth. I'm not trying to get rich overnight. I'm trying to build wealth steadily over time. Let's put this into a real-world scenario. The market is soaring. Our excited investor is on top of the world. I'm a genius. I'm up 50% in a month. I should have invested more. Maybe I'll take out a loan and go all in. He's experiencing euphoria. He feels invincible, and this is where he's most vulnerable. He starts taking on more risk, convinced he can't lose. Meanwhile, I'm looking at the soaring market and thinking, valuations are getting a bit stretched. Maybe it's a good time to rebalance my portfolio, take some profits off the table from my high flyers, and move them into more defensive assets. I'm not selling everything, but I'm managing my risk. I'm preparing for the inevitable downturn. I'm thinking about capital preservation. Then, the market turns. A small dip becomes a correction. This is where our stressed bear takes center stage. I knew it. It's all gone. My retirement is ruined. I'm going to have to live in a cardboard box. He's in the depths of despair, panic selling at the bottom. The news is filled with doom and gloom, and it reinforces his every fear. But what am I doing? I've been waiting for this. I have my watch list of great companies that were too expensive during the bull run. Now, thanks to all the panic selling, they are on sale. So while the bear is selling, I'm thinking, excellent. The market is offering a discount on high-quality assets. Time to start buying. This is where the real money is made, by being greedy when others are fearful, and fearful when others are greedy, as the saying goes. But it's a calculated greed, based on analysis, not a blind one. It's crucial to understand that the market is a pendulum, swinging constantly between the greed of the excited investor and the fear of the stressed bear. Most people get caught up in that swing, buying at the peak of excitement and selling at the depth of despair. The key to long-term success is to detach yourself emotionally. Stop thinking like an investor or a bear and start thinking like a business owner. When you buy a stock, you're buying a piece of a real company. Would you buy an entire corner store without checking its books first, just because there's a long line outside? Of course not. So why would you do that with a stock? You need a plan. Before you ever invest a single dollar, you should have a clear strategy. Define your goals, your time horizon, and your risk tolerance. What does that look like in practice? It means doing your homework. It means not putting all your eggs in one basket. Diversification is your best friend. It means understanding that volatility is the price of admission for long-term returns. The market will go up, and it will go down. Don't let the stress bear in your head convince you to jump ship every time you hit some rough seas. And don't let the excited investor convince you to chase every shiny new object. Instead, focus on time in the market, not timing the market. The most powerful force in investing is compound interest, and it needs time to work its magic. Think of it like planting a tree. You can't just stare at it and expect it to grow overnight. You plant it in good soil, water it, and let it grow over years. So, how do you cultivate this analyst mindset? Start by turning down the noise. Limit how often you check your portfolio. Constantly watching the price tick up and down will only feed your inner bear or investor. Instead, schedule regular check-ins, maybe once a quarter. Focus on the big picture. Read company reports, not just headlines. Learn about the businesses you're investing in. And most importantly, automate your investments if you can. Set up regular contributions to your investment accounts. This strategy, known as dollar cost averaging, forces you to buy consistently, whether the market is high or low. It takes the emotion out of the equation. You're systematically buying more shares when prices are low and fewer when they're high. It's the analyst's secret weapon. In the end, successful investing isn't about finding a secret formula or predicting the future. It's about behavior. It's about controlling the excited investor and the stressed bear that live inside all of us. It's about having the discipline to stick to a sound, logical plan, even when it feels like the whole world is going crazy. It's not as thrilling as chasing rockets to the moon, and it's not as dramatic as panicking about an impending crash. It's a slow, steady, and sometimes boring process, but it's the proven path to building real, sustainable wealth. So next time you feel that FOMO creeping in or that panic starting to rise, take a deep breath, step back, and ask yourself, what would the analyst do? Thanks for watching Finance in Focus. Don't forget to like and subscribe for more tips on how to invest smarter, not harder. See you next time.